Welcome to the channel, dear friends. I'm your host, ever dedicated to uncovering the truths behind the polished facades of those steering the world's biggest economies. Today, we dive headfirst into what could be one of the most significant debates of the 21st century, how artificial intelligence, AI, is shaping economies, financial regulation, and even the delicate art of central banking, and how, once again, the government might just be sleepwalking into disaster. The catalyst for today's discussion: Federal Reserve Governor Michelle Bowman's recent speech. On the surface, it was an acknowledgement of AI's growing significance to the economy, both in its promise and its risks. Peel back the layers, though, and we find it reveals deeper tensions: the tug-of-war between innovation and regulation, the potential upheaval to labor markets, and the Federal Reserve's blind spots when it comes to the long-term consequences of their laissez-faire approach. So buckle up, because today, we're dissecting the contradictions and asking the tough questions the mainstream media shies away from. Let's start with Bowman's central argument: we need not rush to regulate. She claims that heavy-handed oversight could stymie innovation, push activities outside the regulated financial system, or worse, halt AI advancement entirely. On the surface, that sounds pragmatic, right? After all, history warns us about regulatory overreach in budding industries. Consider how early internet regulation stymied growth for years, or how excessive patent controls throttled biotechnological advancements. But here's the first major red flag: the Federal Reserve seems more concerned with preserving the flourishing of AI under the guise of economic efficiency than addressing the potential systemic risks it introduces to an already fragile global economy. Regulatory inertia rarely ends well, especially when emerging technologies penetrate critical systems faster than governments can adapt. Bowman also emphasized AI's potential to improve operational efficiency, combat fraud, and expand access to credit. These are all worthwhile goals. I mean, who wouldn't want fewer data breaches, fairer loans, and lower costs? But remember, the same tech that offers opportunity also acts as a Trojan horse for massive upheaval. Take the banking system. AI optimizes lending practices and reduces operational inefficiencies, sure. But isn't that eerily reminiscent of the unchecked enthusiasm for financial engineering in the early 2000s that led to the subprime mortgage crisis? Automated decision-making, driven by algorithms, could easily misprice risks, especially in a sector already infamous for herd behavior, moral hazard, and over-leveraged financial products. Look at the mess GPT-based AI models like ChatGPT are already causing in other industries. False data proliferation, unchecked biases, and overwhelmingly opaque decision-making processes. Imagine applying this flawed AI logic to high-stakes economic sectors like lending or investment banking. And here's the kicker: Bowman conveniently sidesteps plausible negative scenarios while assuming that AI tools applied in finance will function exactly as intended. But the devil's in the details, as economists say, and AI frequently proves unreliable when put to the test in dynamic, real-world environments. Let's talk about Bowman's next point: how AI is reshaping labor markets and productivity. She notes that AI could eventually affect monetary policy by altering the natural rate of unemployment and the natural rate of interest. Here's where the Fed starts writing checks it may not be able to cash. Its optimism about productivity gains feels out of sync with realities on the ground. Recent productivity data paints a convenient narrative: U.S. labor productivity has advanced 2.3% annually over the last 8 quarters, compared to just 1.3% in the decade pre-pandemic. Some policymakers have explicitly connected these gains to AI. But, wait for it, not only is this connection tenuous at best, but even if AI is fueling productivity, there's a glaring disconnect between theory and impact. Yes, AI increases efficiency in certain sectors. But at what cost? Last week, Goldman Sachs estimated that AI could disrupt over 300 million full-time jobs globally, particularly in advanced economies like the US. As automation sweeps across finance, logistics, healthcare, and manufacturing, we're looking at a tsunami of labor displacement. What happens next? Bowman didn't say it explicitly, but let me spell it out for you: a vicious cycle of rising inequality, where a handful of tech conglomerates and capital-owning elites rake in obscene profits, while displaced workers face chronic underemployment, precarious gig work, and declining bargaining power. In simple terms, AI-driven productivity doesn't lift all boats, it drowns most of them. In sectors like finance alone, McKinsey Global Institute predicts automation could replace 25% of current jobs by 2030. Think less human intervention in stock trading, customer service, and lending, and more algorithm-led profits for Wall Street. Meanwhile, the median U.S. household income declined to $74,580 in 2022, down 2% from 2021. Combine wage stagnation with skyrocketing costs, and ordinary workers are already feeling squeezed. AI risks turning this into a societal crisis. Contrast this with the tech executives pushing AI advancement. Google, Microsoft, and OpenAI CEOs argue that automation will augment humans, not replace them. That's PR spin, folks. Historical data tells us otherwise. For every upskilled worker who graduates into a high-paying job managing AI systems, dozens more will find their skills obsolete. I know what you're thinking, isn't it the Fed's job to address these macroeconomic disruptions? In theory, yes. In practice, they're a step behind, as always. Let's pivot to Bowman's final point, AI improving monetary policy. She suggests that better quality data, courtesy of AI, could enhance central bankers' decision-making, potentially improving inflation forecasts, employment metrics, and interest rates. Listen, this is the kind of comment that sounds great in a politician's speech but crumbles under scrutiny. Why? Because monetary policy is inherently reactive, not proactive. Take the last 3 years, supply chain shocks, soaring energy prices, and record high inflation completely blindsided central bankers. Now they tell us AI will fix their forecasting failures. Please. Economic data, no matter how sophisticated, isn't a crystal ball. Moreover, there's risk of AI creating a feedback loop of bad decisions. If policymakers lean too heavily on AI-made projections, without understanding the assumptions it's based on, they may double down on flawed fiscal or monetary decisions. Here's another layer of irony: the same central banks pushing for digital transformation barely have an emergency policy framework for when algorithms go haywire. Let's step back and talk big picture now. Bowman's speech reflects the Federal Reserve's perpetual mantra: trust technological innovation, minimize regulation, and let the market self-correct. This laissez-faire philosophy dominated the lead-up to every bubble in recent memory: the dot-com crash, the housing collapse, and yes, even crypto's recent implosion. So why should AI be any different? Left unchecked, AI will amplify systemic inequalities, destabilize labor markets, and inject new risks into global financial systems. Regulators like Bowman claim to recognize the stakes but repeatedly defer decisive action under the guise of avoiding overreach. If history is any guide, this is precisely how crises start, with timid warnings, delayed regulation, and misplaced optimism. Here's the truth: we're at an inflection point. AI could either catalyze unprecedented economic gains or plunge us into the next great recession. Policymakers like Bowman must stop treating innovation and regulation as binaries. They have a duty, to workers, businesses, and society at large, to proactively shape AI's impact rather than waiting for chaos to erupt. The stakes couldn't be higher. Will the Fed bravely confront the risks AI introduces to financial systems, or will they blindly cheerlead its growth until the next bubble bursts? What do you think? Drop your thoughts in the comments below. Remember, your voice matters as much as your wallet. Till next time, I'm your host, calling it as I see it. Don't forget to like, subscribe, and hit that notification bell. Together, we'll keep holding the powerful accountable.